Welcome back, everyone, and thank you for joining me again here on the podcast. We're going all in on a subject that every trader, every long-term investor, and anyone who follows crypto closely needs to understand. Bitcoin versus the Federal Reserve. On paper, Bitcoin was designed to live outside the control of central banks. Its supply is fixed, it can't be inflated away by policy decisions, and it doesn't rely on politicians or interest rates. But the reality is that Bitcoin doesn't trade in a vacuum. It trades in portfolios right next to stocks, bonds, and commodities. And because of that, it still feels the push and pull of the macro machine. And no machine has more influence than the Federal Reserve. So in this episode, we'll break down why the Fed still has Bitcoin on a leash, what history tells us about rate cycles, how the narratives of digital gold and inflation hedge have held up, and what could happen depending on which way Jerome Powell and the central bank move next. This isn't just about charts and data points. It's about psychology, liquidity, and the big question of whether Bitcoin can ever truly decouple from the traditional system. Let's begin with the core issue: why the Fed matters. The Federal Reserve sets the price of money in the United States, and by extension, it influences global liquidity. When the Fed raises interest rates, borrowing becomes more expensive, credit slows down, and risk appetite dries up. When the Fed cuts rates, money becomes cheaper, investors search for yield, and risk appetite explodes. Because Bitcoin is still treated by most large investors as a high-risk asset, it gets pushed around by these tides. We saw this in stark terms during the tightening cycle of 2022. As the Fed hiked aggressively to fight inflation, liquidity was sucked out of the system. Stocks fell, bonds collapsed, and Bitcoin went into freefall, dropping from nearly $70,000 to below $16,000 in less than a year. Crypto had its own disasters: Terra, FTX, and a wave of bankruptcies. But the macro backdrop was what magnified the pain. With rates high and liquidity tight, there was no cushion. Every internal problem hit harder because the Fed had slammed the brakes. Then came the pause. As inflation cooled, the Fed signaled it was done hiking. Markets began to breathe again. Bitcoin clawed its way back to 30,000, then 40, then 50. The narrative of Bitcoin as digital gold re-emerged, helped by geopolitical tension and distrust in banks. By the time the first wave of Bitcoin exchange-traded funds was approved, the market was already turning risk on. The inflows into those funds poured gasoline on the fire, and Bitcoin powered past 100,000 for the first time in history. Now the question is, what happens next? Inflation is still sticky. Growth is slowing. Traders are asking whether the Fed will blink and cut to support the economy, or whether it will hold rates higher for longer to squeeze inflation out of the system. That decision will ripple straight into Bitcoin. Let's map out the scenarios. If the Fed cuts rates, the immediate effect will be risk-on behavior across markets. Stocks will rally, bonds will breathe, and Bitcoin will likely surge as investors pile back into assets with higher upside potential. The narrative of Bitcoin as a store of value gets reinforced when real yields drop. Institutions that have been hesitant will feel emboldened to allocate more. Retail investors will see green candles. That's the breakout scenario. Bitcoin pushes out of consolidation and sets new highs. If the Fed holds steady, no cuts, but no hikes either, Bitcoin may remain in this sideways range. Investors will be cautious. Every inflation print will be scrutinized. Every word from Jerome Powell will send the market swinging. Bitcoin will grind higher or lower within a band, waiting for clarity. It's not as exciting as a breakout, but not as painful as a crash either. For long-term holders, it's a chance to accumulate quietly. For short-term traders, it's a grind. And then there's the hawkish case. If the Fed decides inflation is still too strong and signals more tightening, Bitcoin could get hit hard. Risk assets hate higher rates. Institutions will reduce exposure, retail traders will panic, and Bitcoin could retest support levels well below 100,000. It wouldn't end the bull market, but it would remind everyone that liquidity drives everything. Now let's zoom in on the narratives. Bitcoin has always been marketed as digital gold, as a hedge against inflation. But in the short term, Bitcoin is often traded more like a tech stock. When liquidity dries up, Bitcoin falls. When liquidity floods in, Bitcoin rallies. That's not how gold behaves. Gold is a safe haven. Bitcoin, at least for now, is still a high beta version of risk-on assets. But over longer horizons, scarcity does give Bitcoin a hedge-like quality. In countries where inflation has spiraled, Argentina, Turkey, Venezuela, Bitcoin adoption has increased. Globally, its fixed supply remains its strongest argument against fiat devaluation. So the hedge narrative works on a macro timescale, but in the short term, Bitcoin is still tethered to Fed policy. There's another wrinkle: institutional products. With Bitcoin ETFs now live, institutions have a clean pathway to allocate. That makes Bitcoin even more sensitive to macro signals, because the same desks that trade equities and bonds are now trading Bitcoin exposure too. If those desks are risk-off because of Fed policy, Bitcoin gets sold alongside everything else. If they're risk-on, Bitcoin gets bought. So ironically, as Bitcoin has become more legitimate, it has also become more correlated. Altcoins are even more leveraged to Fed decisions. Ethereum has lagged Bitcoin recently, struggling to maintain momentum while Solana and XRP have captured attention. Solana, in particular, looks ready to benefit from the next wave of exchange-traded products. But make no mistake, if the Fed turns hawkish, altcoins will bleed harder than Bitcoin. And if the Fed cuts, altcoins will explode higher, often outpacing Bitcoin's gains. The central bank doesn't just move Bitcoin, it moves the entire crypto complex. So where does that leave us? Right now, Bitcoin is consolidating near record highs, waiting for clarity. The Fed is the next catalyst. Traders are holding their breath. Institutions are positioning carefully. Retail is watching nervously. And the narratives are colliding. Bitcoin as digital gold, Bitcoin as risk asset, Bitcoin as hedge, Bitcoin as speculative rocket ship. The truth is that it's all of those things at once, depending on liquidity and sentiment. The key is understanding that this tug-of-war won't last forever. As Bitcoin's market cap grows and as adoption deepens, it may eventually decouple from central bank policy in the way gold has. But we're not there yet. For now, the Fed's shadow is long. The next rate decision won't just move stocks and bonds. It will decide whether Bitcoin breaks out, chops sideways, or suffers a pullback. So as you plan your own strategy, ask, how exposed are you to the Fed's decision? Are you prepared for volatility in either direction? Do you see Bitcoin as a short-term trade or as a long-term hedge? Your answer will dictate how you navigate the weeks ahead. And always remember this: Bitcoin versus the Fed isn't a single showdown. It's an ongoing saga. Every tightening cycle, every easing cycle, every inflation scare, every liquidity shift, Bitcoin is tested. Each time it proves a little more resilient. Each time it earns a little more legitimacy. But each time, it also reveals just how tied it still is to the broader system. That's where I'll wrap it up. Drop your thoughts in the comments. Will the Fed cut, hold, or hike? Smash, like if you're still bullish on Bitcoin. And don't forget to follow for the next update. And as always, protect your crypto, secure your holdings with a ledger using the link in the description, and we will see you at the top.